So good afternoon and welcome to this special Rhodes Centre for International Economics and Finance event. The name, the benefactor behind the Rhodes Centre, William Rhodes, Brown Class of 57, is also one of the founding members of the Group of 30. Now for the students here, you may have heard of the G20, you may have heard of the G7, but you might not have heard so much about the G30. Well, they're just as important, but they're rather different. Rather than the other Gs being composed of countries, this G is composed of individuals. It's a group that's drawn from finance, government, academia, formed in 1978 to deepen understanding of issues relating to global finance and public policy and the intersection thereof. The people who joined the G30 are people such as Paul Volcker, Jean-Claude Trichet, current policymakers such as Mark Carney, Ernesto Zedillo, and the panel that is here today that I will shortly introduce. They don't get as much press as the G20 or the G7, but they have been instrumental in pushing reforms in banking, currently pensions with Adair Turner, and in general crisis management in financial affairs. The report that we're going to talk about today came out in November, and it's an incredibly important document because it perhaps tackles one of the most difficult areas of banking reform 10 years after the crisis, the area of culture. That is doing the right thing and surviving in an area where doing the right thing, as we see time and time again, is very difficult to do given the way the incentives are structured. So the bottom line is, how do you engineer a better, more responsible financial culture, both within institutions and across institutions? And that is the task that the committee that wrote the report set to themselves. To get us started, I'd like to ask Bill Rhodes to give us 10 to 15 minutes on the report to say what he wants to say about it. And then we will turn over to the gentleman on the end, Brendan Greeley from the Financial Times, who will chair a panel discussion. And then we will bring everyone else into the conversation. Our panelists, along with Bill, are the other authors of the report. Stuart Mackintosh, who is in the middle, Executive Director of the G30. Nick LePan is a Canadian banker and banking regulator, is chair of the Canadian Public Accountability Board, which regulates public companies. And Elizabeth St-Onge is a partner in Oliver Wyman's Financial Services Group, and she leads their work on financial institutions in North America to understand, measure, evaluate, and refine their culture and conduct, which seems to be the heart of the affair. So without further ado, welcome back to Brown, Bill. Please tell us what we need to know.
Thank you very much, Mark. I must say that I am so happy that Mark agreed to take this role on to run the Rhodes Center here at Watson. And to me, that has made a big change in what this group is doing. I also want to thank my distinguished panelists here, all of whom worked with me on this report on culture and conduct. And I'd like to start off with just saying that when I left Brown, I needed a job, and I ended up with Citibank. And one of the things that were beaten into me and to all trainees at that point in time is something that unfortunately I think has been forgotten by most financial institutions, banks included, is that first of all, the bank's reputation and the financial institution's reputation was key. You were always told that's what you had to protect. And it's always easy to build up one's reputation in the best of times, but when you do it, you have to be very careful you don't lose it. And we've seen it, which I'll get into very briefly, a string of institutions that have lost it. And so protecting the bank's reputation was key, as I said. Second of all, was to deal with your clients, your customers in an honest, straightforward way. And the third thing was that you have to be part of your community. Both the institution in which you're working for, as well as you as an individual, have to be part of the community. And I think all three of those, unfortunately, were lost over the last few decades in the financial area, and this came to fore with the Great Recession. And so this is what we're going to talk about here today. The group of 30 has been focused on this issue since 2011, coming out of the Great Recession, to figure out what went wrong. And we issued our first report in 2012, which was a report on governance structures, talking about what the boards were doing, or in this case, not doing, And then in 2013, we called for a new paradigm between financial institutions and regulators and supervisors. What do I mean by regulators and supervisors? I'm talking about the Federal Reserve System in this country, the FDIC, controller of the currency. In the case of the UK, it would be the Bank of England. I could just run through it, but that's what we were talking about. And finally, we turn to the subject really at hand here, which is conduct and culture, making a call for sustained reform and growth, because we felt that at the heart of all these problems was a lack of culture and a lack of conduct by the financial institutions, which came to fore so strongly in the Great Recession. At the time we did this report in 2015, we decided that we would follow up to see if the recommendations we made were being followed, both by the individual financial institutions as well, frankly, as the regulators and supervisors. And that's what I really want to address today. And this final report was published in November of 2018. The people on this panel were all involved in that very deeply. And I would say it divided into three parts. First, a comment on repairing trust. Where are we now? Because I think it's fair to say that the public lost trust in the financial system and in the banking system, almost worldwide. But particularly, I would say, the case of the United States, Europe, but I would say really worldwide. Second, evidence of progress. There is some good news, but I don't think it's a time for complacency, and we still have a lot of work ahead, as I mentioned, and we'll give specific examples of the continuing scandals we see coming up. Third is the ongoing shift in culture and conduct, in the sense it's got to be part of the bank's mindset and the practice of everyone involved in the institution. So first of all, repairing trust. Where are the banks today? The industry standing among voters and the public remains in really low order, I would say in disrepair. In fact, the Edelman 2018 Trust Barometer, which is prepared annually for the World Economic Forum, shows that only 54% of the general public that had been talked to for this particular report had trust in financial services form. I mean, that's a pretty sad statistic, which is this is who you're dealing with, where you keep your money. I think 10 years on from the global financial crisis, it remains clear that a great deal needs to be done to repair confidence in financial institutions and regain trust. And then we talk about recent scandals that we read about in the paper and have for the last couple of years almost every day. One is, of course, the one probably read most in the United States because it's an American bank, is Wells Fargo. And I think this is a perfect example and demonstration of what happens when you have incorrect incentives for the people working in the institution to achieve what they need to do in their work. Also, it's an example of what happens when you have a board who doesn't understand what's going on in the institution, or in some cases perhaps doesn't care. And the cost of these cultural failures today are substantial to the individual institution, to the shareholders, and frankly to the customers of that institution. This is not just an American phenomenon. In Australia, there was a royal commission looking at all of the banks in the banking system. And to a great surprise of many Australians, the report was pretty negative on some of the abuses taking place in Australia with the banking system. And one of the worst cases, probably the worst case of money laundering in the history of the world, took place with the leading bank in Denmark, the Danske Bank, where so far they've discovered money laundering up to the amount of $250 billion, mostly money siphoned out of Russia illegally in a money laundering scheme. And I think what's happened there is the CEO was fired, the chief financial officer was fired, the chair of the board was fired, and many of the directors were fired, and has now become a major political issue in an electoral campaign in Denmark. I mean, this is a fallout of something like this. And I'm sure you all have read about Goldman Sachs and the IMDb scandal that took place in Malaysia. And That involves, I don't know, 5, 6, $700 billion of funds that were lent under very bad circumstances, illegal circumstances. Most recently in the UK, we've had the Metro Bank and Lloyds Bank, for various reasons of bad practices to come to fore. And you're probably all reading about the Deutsche Bank, because we've talked about most recently their attempted merger with the Commerce Bank. But there you have numerous scandals, from money laundering of Russian cash to the LIBOR interest rate scandal. And also in Europe, as a last example, I would mention ING, which is one of the largest banks in Holland, and had a record fine for a Dutch institution of the equivalent of 900 million US dollars for money laundering. All of these things that I'm mentioning have happened in the last 2 years, some of them in the last few months. This is just an indicative list. There are many, many others I could go into, but it's cases like this that damage the trust of the public in dealing with banks and financial institutions. And so this is, again, one of the reasons we've gone into this report. We talk about evidence of progress here, and I think we see a number of areas of progress from the time we did our last report, which was 2015, to the one we did in 2018. And but we should understand that this is no time for complacency. These examples tell us how much work still needs to be done. So what has a group of 30 found? Boards have upped their game, but need to continue to focus on conduct and culture and embed it into institutions. And it all starts at the board, through the CEO, through middle management down to the teller level. And it's important that it starts at the board, where culture and conduct are key, and that boards ought to be looking at that as one of their prime duties. And I think that one of the things that makes us feel somewhat better is that most boards are now using culture and conduct dashboards to measure tactics, in place to address the concerns I've mentioned. And we recommend that all banks create a dedicated board-level committee to monitor conduct and culture. And we found about 1/3 of the banks that we monitor have, in fact, set aside a separate committee to look at culture and conduct. And whether a committee is formed or they just discuss it at the board in general, I think it's very, very important that they're in that. And we're also recommending that the board members kick the tires, that they actually go out and see what's going on in the branches. They know what their institution where they're on the board is doing. And as I mentioned, all of this has to start at the top and, as I said, go right through the teller level. And it has to start at the beginning when an employee starts working at an institution. But it's not good enough just to have an indoctrination program. It must be ongoing. And that's why we talk about these dashboards. And the training has to be from the beginning right through the time the employee, no matter what the level, and we're talking up to senior management, and even boards need to have this training on a constant and consistent basis. And one of the areas is, I think it's very, very important, is that there are tools and metrics that you can judge all of this to be happening. And what we have to do is to encourage and reward good actions, for instance, and protect whistleblowers. And in other words, make it plain that if somebody in an institution sees that their colleagues are doing something wrong, they raise their hand and they're going to be rewarded for it and not pushed out of the institution, which we see too often. And how do you handle those that we call the bad apples? First of all, if it's not a serious offense, you take it out in their compensation, their bonuses. If it's a serious offense, you fire them. And they have to know that this is part of it. You can't excuse it. And we've had too many cases that came up, particularly since at the time of the Great Recession, where these were just overlooked. And employees thought that they could get away with almost anything, right up to almost the top levels. And so we're talking about strengthening 3 lines of defense. The first line is the business units themselves. They have to own the culture and conduct. The second line are the risk managers who must ensure compliance with rules, norms of behavior, and conduct. And the third line are the auditors who must review the process and its effectiveness. Supervisors and regulators are very important, but they can't make a culture in an institution. The institution itself has to have a culture of its history and practices, but what they can do is monitor it. And I think there was a failure along the line of the institutions, but also of the regulators and supervisors in many countries, including here in the United States. And so I think that what might have been acceptable yesterday should not be acceptable today. And I think permanent change is starting to resonate in this area. And we've been pressing this case globally. Stuart, Mackintosh, and I took a trip to China at the middle of December last year. Most people don't realize, but the largest banking system and largest financial system in the world is no longer in the United States or Europe. It's in China. And most people don't understand that. And the People's Bank of China, which is the central bank of China, and the present head of that, Yi Gang, called in the head of every major Chinese bank and the heads of many of the foreign banks operating in China to hear us talk about this report. And it was made very plain to them that they were going to be judged on this by the regulators in China, principally the People's Bank in China, which is probably, those of you who follow China, the most efficient institution in that country. And so what we're seeing is that the regulators are taking this seriously, and the Basel Committee, which is a group that meets monthly, which the head of all of the major central banks in the world, has invited us to come make a presentation to them, because they feel that this report is a template for what financial institutions should be doing worldwide, and also what regulators should be doing worldwide. One of my concerns, and the concerns of our group here, is that now we've passed into, let's face it, it's been over 10 years since the Great Recession. And the tendency is to loosen some of the controls that were put on during the Great Recession. And in doing so, I think the authorities have to be very careful that we don't get back into the same mindset that we had prior to the Great Recession. And this is why this report, I think, is so important. So I think there's a lot of work ahead for all of us in here, but what we need is permanent change in the mindset, not only to embed the culture and conduct requirements here, but to monitor them and make sure people that don't adhere to them are in some ways castigated, whether it be salary, bonuses, or in the case of things that are very serious, actually fired and released. So that is basically where this report comes out. Progress, yes, but we're a long ways from regaining the trust of the community, and in many cases, the trust of our own employees in doing this. So having said that now, I will turn this over to my colleagues who worked so hard on this report. I don't know who we have next on the panel, Brendan.
Me, I'm going to make people answer questions. That's my culture. So I read this report and I was thinking about cultures that I'm familiar with. Newsroom culture is basically comes down to you're not special and you don't know anything. And that culture is incredibly strong, and it has a purpose, which is that it prevents us from getting over-levered on a single fact. Right? You probably don't know anything, you got to go check it again. We value what we call shoe leather, the uncomfortable work of going out in the world and talking to people. We value door stopping. You get applause in a newsroom if you do that. And those obviously have very clear consequences on the quality of the news that we produce. So their culture is tied to what it is the organization does. The other culture that I thought about is the military, which has a culture of safety. So surprisingly, the military has a culture of making sure that people don't get killed. And I think of my own father, who spent the first half of his life flying jets at the speed of sound, and the second half of his life making sure that nobody in the family was allowed to drive a car faster than 55 miles an hour. So maybe we'll start with Elizabeth. What are other cultures that you have looked to as you work with banking where you can say that is a successful culture? Here are things that you can adapt to yours.
Sure, absolutely. I'll say a couple of things to that, and I will answer the question. But first, I think what we don't want to do is talk about good or bad cultures. What is most important is having the right culture for each organization. So we work with all sorts of financial institutions, and quite frankly, they all have very different cultures. What's important is to make sure that there's alignment with your corporate values, your goals, your strategy, and then the culture within the organization. And where a lot of organizations get into trouble is where they have misalignments. And I'll give you one very easy example, but brings us into perspective. One institution that we've been working with, their key mandate, their thing that they most hold dear to them is customer service. Above and beyond anything else, we need customer service. But their employees who work the client call line, you know, when you have a question, you call in, so the customer service line, those employees are managed by number of calls in a day. So if your metric that determines your success is number of calls in a day, what do you want to do? You want to hang up as quickly as possible to answer the next call. Now, perhaps those two things are not out of alignment. Perhaps the client request can be answered quickly and easily, and they're happy, you did it, you hung up, and the client is very happy. But what happens when the client's request is difficult or complex? Now, suddenly that employee is in a conflict between the values the firm holds dear, which is customer service, you know, no matter what, and their own performance management and what is expected of them. So what we talk with our clients about is it's really about having alignment and clarity around these things and not put employees in that conflict where they're having to balance out various expectations. So that's the long answer. But in terms of industries, look, we've seen, you talked about military. I think military has done a great job in particular around developing leaders. I think the reason why the military has done so well is they spend a lot of time around developing leaders. The aviation industry is another one, you know, current situation notwithstanding, has generally done very, very good. Pharmaceuticals is another industry, oil and gas. These are all industries that have been very clear about their priorities and how they will go at it, because it really is a matter of life and death in most of those cases. But we've also seen other industries that haven't done a great job, and I think of high tech, for instance, right? Where you hear all sorts of stories about abusive behaviors to their own employees, to customers, taking advantage, misusing data. So we certainly see both industries that have done a great job, but also other industries that have conflicts between the various things that they're trying to achieve and are not clear on what is most important to them.
And I think the culture of move fast and break things is a culture that has failed, because what they broke was us. So I think we're really seeing a cultural moment where they are beginning to dimly recognize in the tech industry that they need to operate the way they do in the military or in the pharmaceutical companies, where you just can't get it wrong.
Or be clear on the trade-offs, right? If your culture is innovation, move fast, you know, break things, or you have a culture of cost management, or you have a culture of customer service, or you have a culture of profitability and revenue, you have to recognize that there'll be trade-offs that are needed. But senior leadership has to be very clear on what trade-offs they're willing to make and which ones are not acceptable.
Nick, jump in.
Just a couple of other elements of this, Brennan. When you think of the military or some of these other things, it's not just what their culture is, but it's how they go about reinforcing the culture. You know, so the banking traditionally doesn't like to look very much outside its own doors at what other people have done. It's sort of like best invented here, right? Well, so think about the military. We can either like or not like their culture, but they actually spend a huge amount of time figuring out how, and in the newsroom, I think, figuring out how to reinforce that, how to get it communicated right up and down the line. Some of the things that Bill's talking about that we found that weren't there in banking. So there's a whole bunch of the process stuff, and they spend a lot of time with leadership, understanding how to reinforce that culture. And I remember in a different life, having a fascinating interview with a general in the U.S. Air Force in El Paso, Texas, about the cultural challenges the U.S. military faced when they moved from wars to peacekeeping. because there's a huge amount of difference in culture if you're actually telling a 19-year-old you're going in to fight somebody versus you're going in to try to do some element of peacekeeping. So there's a huge lesson there from a bunch of other organizations about when you're into a new business, when you're into a new area, how do you try to make sure that the culture that you actually want is actually working in your new kind of area. So there's a bunch of process that kind of lessons I think are hugely important from some of these other industries. Stuart?
Let me pick up on one point that Elizabeth made and then follow up with something that Nick has picked up. The first thing about Elizabeth points out, it's definitely the case that we recognize that cultures are different and unique to the institutions. However, when we looked in 2015 and in the process of the multiple reports we've done at the mission statements of the different banks, they were very similar.
Yeah.
Because we expect that bankers are honest, trustworthy, accountable, and so on, right? So on the one hand, they're unique, but actually we expect our bankers to act in a particular way that cuts across institutions, so that the norms are transferable in many ways. And when those norms get distorted and broken, then you have troubles. And to follow up on what Nick was saying, we could really see the difference when we were talking to different bankers, leading bankers, between those leaders who embodied it, believed it, breathed it, walked it every day, and those who were saying, "Oh, it's just a regulatory burden. Stop bothering me about culture." There's a complete difference, and you could just almost instantly tell whether that firm was taking it seriously or not. Were the people inside the leadership living it? And you can judge that quite quickly, actually.
We're talking about banking, but one of the things that it makes me wonder whether what we're really talking about is a problem in the way that we train capitalists. I mean, it starts as you're getting your MBA. I mean, does there need to be a stronger focus before they even enter a bank in the things that they are required to read and the ethics courses that they are required to take before they're allowed to touch somebody else's money?
This is a great point. It was something that the Federal Reserve Board of New York was grappling with. They had a series of discussions with leading MBA course leaders, in Princeton and elsewhere, and they talked to the professors and they said, "Why are you not teaching ethics to your students?"
Exactly.
And many of them said, "That's not our job."
Right.
But the response to that is, but hold on a second, your students are going to leave their school and run the largest firms in the country. Why are you saying you have no responsibility for telling them what is ethically acceptable or not? If they were in law school, in the same school, they would be required to take a course in ethics, and if they fail that course in ethics, they wouldn't be allowed to graduate. So that is a very important point.
Well, there's this interplay that you've all talked about between incentives and culture. You can't have, you need both in order to make it work. There's a lot in the report about incentives within a bank. You talked about customer service representatives who need to be scored on something different. Ultimately, the people who run the bank are scored on return on equity. And so, do we need to prepare shareholders for their ethical and cultural burden as well? Because ultimately, if you are doing culture right within a bank, you are making your shareholders less money. So do shareholders need to be prepared to accept a lower return?
So there's a short-term, long-term conundrum around this one, big time. And in fact, one of the interesting things in the report, both in this one and the previous ones, Bill, was the stuff about, well, what's the role for institutional investors here?
Yeah.
To actually care about what the culture is in these organizations. And if you go to ESG, the sustainability part of ESG, environmental sustainable growth stuff, the sustainability part is about an organization that actually is going to survive and last and prosper over long kind of time periods. And if you think about, well, what is one of the longer term potential advantages of a bank vis-a-vis a Google or a Facebook or an Alipay or any of that sort of kind of stuff, it may well be excellent execution on a real customer service culture, because they're not, if they can have a proposition out there that they're not actually going to be subject to the same kind of problems of some of these other organizations, that's a comparative advantage that's worth real money. So I think there may be a short-term benefit to sort of skirting the rules, so to speak, and having a culture that's suboptimal. But I think leaders of these organizations are increasingly realizing that there's a huge comparative advantage to doing what this report talks about really, really well. And some people in the investment community are actually now starting to include that in how they rate and look at where they put their money. But yeah, maybe there's some need for shareholders to accept that there's some kind of short-term hit. But I'm not even so sure that that short-term hit has to be all that high. You know, there are lots of examples of institutions that actually benefit hugely by really, really seriously, day in, day out, doing a fantastic job with customers.
I think it's, without a doubt, that's very important because when you talk to people or leaders in the industry and some regulators, they'll point out to you that institutions that have a good culture and conduct and live it day by day earn the trust of their customers and clients, so these customers and clients prefer to deal with an institution that does the right thing, that has a culture and conduct. They don't really want to deal with some institution who they read about in the newspaper every day that has a scandal. So there's a bottom line effect here, without a doubt, I think, for an institution having the proper culture and conduct and maintaining it. And I think that more and more what we saw from when we started in 2011 until we did this report is that the senior management of financial institutions, banks, and the boards are starting to see that. And this has been one of the problems, I think, as an example here in the United States at Wells. And it's obviously affected their bottom line. So I think that if you want to just take a look at the bottom line here, having a good culture and conduct and living it day by day, you earn the trust of your customers. And I think that pays off in the long run. One of the comments that you made, Brian, you brought up, and then we had we had several comments here, is I think it's very important that at this level here, when we're talking here at a university, that when you are studying economics or whatever you're studying, but particularly we're talking about economics here, I think it's very important that there be courses in ethics, because so often, if I look back over the years, and without mentioning particular business schools, you would look at their curriculum, and there was nothing on ethics at all that was taught. And I think it should start right at this level. So when someone enters into an institution, they don't want to be part of an institution that doesn't have a good ethical background here. And one thing that none of us have mentioned, but I would just put out, is that during the course of all of these reports we're talking about, we interviewed the head of every major bank in the world, as well as the heads of all the major regulatory agencies in the world. And so I think we've taken this message, and they say they believe in what we're doing, and now we'll just have to see over time if that is the case. And a lot of times you only know when you're tested. But certainly, I think we saw enough of the fallout in the Great Recession that we know we have to make a change. And I think this is important in the session we had in China, because there wasn't an emphasis before on culture and conduct among the Chinese banking system and financial system. And we've seen all the fallout of all the scandals in China. But I think the authorities over there now understand that they have to demonstrate to the public that they can be relied upon, because if not, you're going to have massive amounts of money moving out of China. And that could have a big effect on the Chinese economy, which is already in trouble.
Sorry,
Please,
I just
go
want
ahead.
to add very quickly. So Nick and Bill talked about having a good culture is important because you avoid bad events and you keep your reputation. There's one other element that's really key that shareholders should care about as well, but it's an invisible thing, or it's much harder to track, is employee motivation. Right? There's a wear and tear on people of working in an organization that doesn't feel good. And as humans, the vast majority of us want to belong to organizations that feel good to us, right? That we're proud of, that align with our own ethics and values. And there's a toxic environment, right? You lose productivity, right? You're not as innovative, you're not as caring, you're not as motivated, you don't work as hard. But when you think of these very large institutions with the tens of thousands of employees that they have, imagine if each of those individuals is even 10% less productive or 15% less productive. there's a massive cost, but it's hard to quantify, right? It's invisible, so we don't pay attention to that. But I think that's where the industry will lose out, is if we don't attract the best and brightest, and we don't keep them motivated and being excited to come into work every day and do their very best. As a financial services industry, we will lose out, right? Because it's all about having the best brains and the most creative and innovative people working for these organizations.
You're talking about the famous scene from Mad Men where Don and Peggy are having a fight. And Peggy says, "You never say thank you," and Don says, "That's what the money is for."
And I think also it affects the whole point Elizabeth is saying. If you don't have proper morale in the institution, these employees aren't going to do the job that they need to do to make the financial institution successful. So I think it all gets down to culture and conduct, also gets down to the whole question of morale among the staff and employees.
I want to ask about whether the actual financial structure of a firm can have an effect on morale. Meaning, does leverage have an effect on culture? Can you be a highly levered organization with great culture that's just completely on top of all those risks? Or as you begin to take bigger risks, does it destroy culture?
So one of the things that's interesting, and one of the things the UK has done that people in the US are not ready for yet, they created the group that surveys participating banks. What's the name of the group?
Banking Standards Board.
The Banking Standards Board, which is a voluntary group that major banks in the UK participate in. They came out with their second report recently. They surveyed 37,000 people who work in the financial services industry, and then they did a number of focus interviews. One of the fascinating things, Brendan, is when you look at some of the results of areas where culture and conduct isn't where it should be, it actually doesn't vary a lot between certain types of businesses. It's fascinating. So the nature of the business, so you could think of, say, a wholesale investment banking business as being the one that's likely to be the more levered, and the one where, it's all the cowboys, and when it's likely to be the bad culture, and that's well, in fact, the issues are often very similar across that type of business and a retail business, and which is why we've seen a bunch of the recent problems haven't been in the wholesale businesses, they've been in the retail businesses, right? And so maybe leverage, maybe leverage can lead to a higher risk-taking environment, but there are some organizations that have been historically high risk-taking, but also have had a very cohesive, very much wanted to protect their reputation kind of culture, and they were who have sustained their operations through centuries. So, I don't think it has to be that way, that just because you've got leverage,
Maybe not, but I do think that some of the evidence we gathered when we were talking to the different bank leaders was that you do get, or I got a sense that there might be such a thing as a Goldilocks bank, where the scale is not too big. So the CEO and the chairman can look down into the bank, personify the culture. The board all understands the culture. All 200 or 300 MDs in the bank are known personally by the CEO. There is interaction, and signaling is clear. If something goes badly wrong, that person is fired. That person's supervisor is also fired, and so I do think there's something about scale. When you're talking about 250,000 people, it's very hard to manage your culture across different national cultural boundaries, across different states, different regulations and regulatory structures. So I that's how I would dice it. I'd say, yes, some banks you can get your arms around, but if you're a massive GSIFI, perhaps not.
The complexity of the business, right? The scale and the complexity.
I had a question about some of these retail violations, and then I want to open it up to the audience as well, which is that when you look at some of the things that Wells Fargo did, for example, or even the robo-signing that many banks were guilty of, I wonder, would somebody have instituted that who'd ever been foreclosed on themselves? Meaning, do banks need diversity in terms of backgrounds, in terms of incomes, in terms of people who have real life experience with the
Absolutely.
consequences of rotten organizations.
Absolutely.
So if everybody's nodding their head, how does that happen? Do we need to, does this start at the MBA level? Like, how do you fix recruitment so that you have people from those backgrounds who prevent those violations?
Exactly. I would just say that I think that that is extremely important. And one of the things we emphasize in our report is diversity. Because you're dealing with your client base, which is a diverse base. And if you don't have people that come from that base, it's very difficult to maintain a culture and conduct. So I think these are all elements that I think are extremely important. And I think it's fair to say that this is being realized more and more today. And this is something that really has to come from the institution itself. The regulators and supervisors can't tell you what culture and conduct you ought to have. You have to have your own. All they can do is monitor it, as I said before. But diversity, and that's something we had not emphasized in our conversation before, I think is key. It really is key.
And it used to be thought that if you were a board member as a director sitting on the HR and compensation committee, the main job was to figure out the CEO's salary, and that was about it. Well,
Okay.
that's not true anymore. The main job, and probably the more important job for what we're talking about, is to worry about and to ask management about what are the hiring practices, what kind of diversity policies are we having, how's that really working, what's going on at the front line, what is the culture telling us, all that sort of kind of stuff. So there's a huge role for boards, for example, in this.
Okay.
Give a shout out to Gail Kelly, who also was on our team in the leadership for this report, and she stepped down a little while ago from her position as CEO of Westpac, one of the largest banks in Australia, and actually came out of the review quite well, the Australian banking review. But when she led that organisation for more than 10 years, when she left it, almost 50% of managers were women. And I don't think that's the case in most other banks in the world. It has to be a constant focus by the leadership, day in, day out.
Big deal.
Well, let me open it up. We've got about 10 minutes. Who has a question?
We've got a little bit more.
We have we've got,
I
okay.
may leave at one, but.
Great, okay, sure.
Well, I think it's a fascinating
We have a
report.
mic.
Fascinating report, and I applaud the working group very much for putting it together. The emphasis on culture, I particularly applaud as a social scientist who tries pretty much as a matter of my own research success to convince other social scientists that culture really matters. I was especially interested in Nick LePan's remark that bankers don't like to look outside very much for their culture, and I suppose that's part of what you all are really trying to get them to do, to pay attention to some outside stimuli. I know what I end up arguing half of the time with my colleagues in advocating for the role of culture is how to respond to the issue of incentives. And my colleagues will say, look, forget about culture. Nobody can measure it. Nobody can change it. Nobody knows what it is. It differs across firms. So forget about it and look at incentives, because that's researchable. We can actually do something about that. So that's my question. One of your recommendations is, just as an example, that quantitative sales targets and compensation for sales staff should be disconnected. But put simply, can a single institution do that? The competitive pressures are just too great. I look at derivatives markets. You can tell Citibank to disconnect those two things, to set up the incentives differently. Can they do it? They're always worried. The next quant from the Sloan School of Management is going to go to Morgan Stanley and start boosting the bottom line too much. And if those guys can hire 3 of those quants, it actually begins to make a difference. So Citibank's board then has to worry about the shareholders. I think, in a way, that's the crux. So it boils down to the purpose of the firm, and can culture be changed without an industry-wide shift in practices?
Go for it.
I want to pick up something in answer to your question that Nick said about the necessity for industry action.
Lean into your microphone.
And why there's a difference between the UK and the US in this, and it's a bit of a bit disappointing. The industry in the UK have recognised that, and therefore they created this institution to pursue analysis of how they were doing vis-a-vis one another. And so it wasn't, so it wouldn't provide, confidential information, but it enables senior bankers to look and see how they're doing vis-a-vis the other competitors. Are they adhering to norms? Are they falling behind? And so on. And it's very helpful to them when they're making judgments. And it creates this notion that, as you said, that there are societal norms in how you should perform, because you're operating with guarantees from the government and so on, and you have social and societal goals. The problem in the US has been a resistance to that, and bankers are still saying, no, we don't want to have some sense of common standards, of common ways of approaching these issues that we all confront. And so it's atomized in a way that is not as helpful, I think.
But I think if you want to take a look at example, and I've mentioned Wells Fargo a number of times, is where you had the incentives, down into the consumer area, all really up almost to the head of the consumer bank, tied into incentives. And you see what happened there. And this is not a new issue. I remember doing a report for the Institute of International Finance after the Asian financial crisis as to what went wrong there. And it was interesting that some of these same things were prevalent then. In other words, these issues we're talking about are not new. The problem is, as my friend Paul Volcker and colleague says, Bill, he says, every 10 years, the bankers learn and then they forget. And I said, unfortunately, the way society is moving today, it's not every 10 years, it's every 5 years. And so what we tried to do in this report is to set something down that can really be embedded, and so institutions understand that they have to really change. And I can remember walking into banks back 20 years ago, and we had one of our many problems with low doc, no doc on the consumer side. And I'd walk into these institutions, and they'd have these big banners and plaques saying, these are our cultural norms. And people used to be given cards to carry with them so that they could look at them. But there was never any embedding, never any follow-up, and frankly, there was never any training on this. And so I think this report is intending to try and establish and embed this. And your comments are very correct. And if we can't do it this time, I have to tell you, the next time's even going to be worse, because when we talk about the new, the new automation that was going in, and the AI and everything else, I think it can be even worse than it was before.
Yeah, I agree.
And so you really have to go back to basics, or we're going to face a real catastrophe the next time we have a financial crisis.
And there's only a certain amount that the rules can do to have common behavior across the whole industry. You do have to have a basic structure of rules, because that sets up redress systems and so on. But you're not going to be able to have a set of rules that forces everybody to do everything up to the current kind of standard, because the stuff moves too fast. AI is a great example, right? So the institutions always have to do a bunch of this themselves. I would argue they have to do 3/4 of it themselves. But if you don't have a basic structure of rules, about requirements for treating customers in certain kind of ways and all that sort of kind of stuff, generic kind of principles, things, you don't have redress mechanisms to work. But to think that you can force everybody to do a sort of basic common standard and keep that up to date through a regulatory system of market conduct, I think is a chimera.
And you say that as an ex-regulator.
I do.
Thank you. I have a question that's directed at Bill Rhodes, but I guess I'd preface it by just saying thank you for the support you've given the Rhodes Center. It's really been going gangbusters this year. But the question is this: you start with your autobiography and you say, when I was coming up in the training program, and I've heard similar stories from a lot of bankers, enough so that I believe them, but I think this opens the question of where this culture came from in the first place. And presumably it didn't exist in the robber baron era. And then it's built in the mid-20th century, and then something unravels in the late 20th century. And I guess I have two hypotheses. One is that this has something to do with globalization, and that in the early 20th century, which was highly globalized, or the late 20th century that was highly globalized, it was harder to have a culture like this than in a relatively closed national economy. And some speculative evidence for that would be that a lot of the scandals you reference come from emerging markets like Russia or China or Malaysia. A second hypothesis would be that there's something about progressive taxation in the mid-20th century, that if all the profits you're going to make in one of these short-term deals is going to be taxed away anyway, you're not going to care about it as much. Once you get to the tax cut era of the late 20th century, you start counting these chits in a way that you weren't in the mid-20th century. And I'm wondering how you'd react to those hypotheses.
Well, I would just say that I think that the culture and conduct that I mentioned when I entered in was drawn out of the school of hard knocks coming out of the Great Depression, where the Pecora Commission that was appointed by Franklin Delano Roosevelt ended up putting the heads of most of the major New York banks in jail. Now, that didn't happen this time. And so it was really, I think, a tough lesson learned by what happened in the Great Depression. And you never saw any of this in the, in, let's say, the 1940s, 50s, 60s. It started coming up with your point on globalization, the opening of the international markets, LIBOR, et cetera, and so the cultures were basically lost internationally. And Stuart mentioned how difficult it is to go across border lines. And London was the example. The world financial capital, invented LIBOR, and this is where you wanted to be. But a lot of these ills on investment banking come from there. So I think your point is exactly correct. And the question is, can we go back and learn from this? And one of the points that has been made, and I don't want to mention Elizabeth Warren here too much, but she is she is a representative of this area of New England. And, I've read a lot of her stuff that she comes out with. And, what she's basically saying is that, like Paul Volcker, you have these things happen again and again. And so what we're trying to do in this report is to take into account the globalization and how that can be dealt with the morals that we need to have. And I had the head of the Nederlandische Bank, which is a central bank of Holland, talk about when he was a young man growing up in Holland. He said there were three people that he was taught to trust by his family. One was a local minister or priest. The second one was the school teacher. And the third was his banker. And he said, we've come a long way from that. And unfortunately, that's the truth. And that's why I emphasize this point about being part of the community. And so you have to get back from all this globalization in many ways, and you have to be part of your community. And you have to know your community, and that's where diversity comes in. And I think we got away from that. And I think the blame lies basically with a financial institution. Coming out of the Great Recession, people, blame the regulators, and there's plenty to blame with the regulators. They didn't see it coming. They didn't want to see it coming. The rating agencies were the same. But at the end of the day, I blame the banks most of all because they are the ones running the institution. So I agree with all of your points. And the question is, can we come back to these basics? And we're going to be tested with the next crisis that comes out. But with all of these, this new technology out there, it's going to be much more difficult than it was in the past. So this is really the challenge, and that's why all of us on this panel, coming from different backgrounds, feel so intense on trying to get this, this particular report understood and sold worldwide. And hopefully we can, only time will tell. But thanks for the question.
I would add to that, actually. I think about this quote all the time. I was talking to a man who runs a bank in Lafayette, Louisiana, who said, one of the reasons that we didn't get into trouble during the mortgage crisis is that my regulators are the people I go to church with. So if I'd screwed up, all of that, there's a lot of social capital that I would have lost if I'd done something wrong. And the damage I would have done would have been local, and it would have been the people I know. And I think it's very easy. The second you move outside a single parish or county, you begin to lose that accountability.
Thank you all for coming. I found this talk very compelling. Thank you, Dr. Blythe, for putting this together. My question is really building on the last one, which I thought was a very shrewd question. It's about culture and regulation. Do you think that the reason that you talked about it in the 60s, 70s, and 80s, there was this culture of not having risk, of looking out for customers? The last questioner brought up progressive taxation. Do you think that was connected to the regulatory environment of that, where banks couldn't charge more than 6% interest? It was really hard to export capital. There was a very clear line between commercial and investment banking. Do you think that part of the moral decline that you've been talking about in banking is connected to the deregulation that has happened over the past 30, 40 years?
Well, that's a very good question, because you get back to people who say, why did we rescind Glass-Steagall, which came out of the Great Depression, where you had the separation of commercial and corporate banking from investment banking. And you can make a case either way for that. I think the basic problem here, though, is not just regulation. It's really within the institution itself, because there were plenty of laws on the books that were there, even with the repeal of Glass-Steagall, that were not being adhered to by the institution itself, by the supervisors and the regulators. So just having regulation itself, if it's not implemented properly on an ongoing basis and understood by the financial institution, isn't going to work. And I think that this is a point that I've learned over the years. And so what we're trying to say in this report is that culture and conduct needs to be implemented by the individual institution, no matter what the regulatory framework is, because the regulatory framework is going to change. And whereas I believe you need regulatory oversight, without a doubt, that itself isn't going to do it if the institution doesn't want to comply with it. And when it's found out that individuals are not doing the proper thing, then they should be in some way, taken legally, whether it be jail, fine, or whatever it is. So you have to implement that. But it's a real question that we're facing now, because you had the buildup of regulation, particularly due to the Obama administration, and now the present administration wants to disband a lot of that. And there's a happy medium somewhere along the line, but regulation itself won't do it if the institution itself does not want to implement the proper culture and conduct. So it's a trade-off. There's no doubt about it. It's just like the question on globalization. It really gets back to the individual institution wanting to do the right thing. And frankly, if I'm a customer of an institution that doesn't want to do the right thing, I wouldn't want to be with that institution. I really wouldn't. And I think it really begins at the level where you are here. And that's why the point earlier made about teaching ethics is really so important. And I got to tell you, when I came up, business schools really kind of didn't exist. They came into Ford to be big time in the 70s and 80s. And if you take a look at the curriculum of some of the top business schools, there wasn't one course that was being taught in ethics, not a single one. And I think that's a reflection of how we ended up, and not just in the United States, also in the UK or wherever. So it all comes down to the points we're trying to make here. But I think the question is very insightful, and this is one of the points we're facing today, and I'd like my colleagues to comment about regulation vis-a-vis implementation of culture and conduct.
So a couple of points on the regulatory side. One of the things that most of these G30 reports have emphasized is the difference between regulation and supervision. So regulation being the rules, supervision being the enforcement. And it's really important when you think of the role of regulation to split those two, because you can under-resource the supervision part, which has happened in lots of places, or you can change the regulations and not realize that then you need to do something else to compensate. So for example, when Glass-Steagall went away, and it happened in a number of jurisdictions, some jurisdictions were better than others in thinking through where the risks were going to migrate to, and then adapting their supervision to try to see whether that was being handled properly or not. The US was not one of those jurisdictions that thought that through fully. So there were big, huge gaps that were exposed in the financial crisis in the US because the US did not have comprehensive consolidated supervision of the investment banks, which other countries that had let Glass-Steagall equivalents go away had put in place. So it's not as simple as, well, there's one kind of deregulation kind of move, and then that is the sort of driver of some of the kind of stuff we're talking about. I want to emphasize a couple of other things that regulation can't regulate culture. you can't set up rules for culture. Now, regulators, you know, you can set up rules around market conduct, and that's my comment earlier to this gentleman about the framework, so those have to be reasonable. Supervision can help in certain areas. So, for example, the U.S. is one of the outliers compared to other G20 countries in not splitting the chair and CEO. And the G30 reports have consistently said that that's an important area where you can help to get the better incentives within inside an institution for the boards to actually treat this seriously and hold the CEO to account on behalf of the shareholders, okay? Well, supervisors in some other countries have actually played a major role in pushing banks to split the chair and CEO role. That's not been an area that supervisors and regulators in the U.S. are willing to touch politically, is my sense. So there are certain things that regulation and supervision can do. Supervision can, because the supervisors go through banks, they see a lot of stuff, and they can actually provide useful feedback to boards. You know, we're seeing stuff down here. Do you realize that? Supervisors can also hold boards to account if they aren't actually treating this seriously at all. You know, you don't have a committee, you don't have any metrics, all that kind of stuff. So there is a role for supervision, but primarily it's got to be the banks. And I would caution against simplistic sort of deregulation, re-regulation. You know, 14,000 pages or whatever it is of legislation after the financial crisis, and however many hundreds and hundreds and hundreds of regulations. I don't know if they're still outstanding here in the U.S. because of the legislation post-financial crisis. I'm sorry, you know, how do you resource that for supervision? So you have to have smarter regulation in some cases, but also you have to focus on the regulation that matters and not pull back on it. And that's what Bill's talking about, that there's a lot of worry around there's going to be pulled back on some of the stuff that really matters. There's a bunch of stuff that probably doesn't, but there's a bunch of stuff that really, really does.
I would just add very quickly, I know we're running out of time, but because I've spent a lot of time thinking about it in our work with financial institutions, right? And on the one hand, we could say, you know, there's been a moral failure, right? Where ethically people are not as ethical as they used to be. But I actually think there's a few other things going on. One is, and Stuart mentioned this earlier, organizations today are far more complex to manage than ever before. So even if you mean really well, an individual who is well-meaning can still get into trouble because the world around us is more complex and the organizations that these leaders are leading are far more complex. So I would point more to a failure in leadership capabilities than a failure in morality. Because I just think that the trade-offs and the subtleties of managing very complex organizations today are on a scale never seen before. The other element that I think is happening is there's far more transparency and far higher expectations, right? I mean, you watch movies like The Wolf of Wall Street. Could you imagine those things being acceptable in today's world, right? So I think as a society, our expectations increase, and there's far more transparency. Things don't stay hidden. Things do come out. And so we just live in a very different world. So I wouldn't necessarily say, well, 50 years ago, people had far higher morality than they do today. I just don't think you can compare the two, the environmental factors and the complexity of the organizations today.
I just want to jump in real quick because it happens to be what we're talking about right now. I take your point that regulators can't fix culture. Can the DA fix culture?
I think that one of the things these reports have said, which I strongly agree with, that is if you don't have a strong enforcement capability in your country, that's a big, huge gap. They can't, no one element of this, but you need everything working. You need the right governance and leadership. You need the right kind of incentives inside the organization. And you do, as Bill said, you need the right external incentives, right? So yeah, the DA can do a lot.
Would criminal prosecutions go some distance towards helping fix culture?
I think that's been a major failure that people have, people involved in the regulatory response and supervisory response after the GFC have subsequently admitted that in the American context, nobody went to jail. Think about the 2000 tech crash. Several people, very senior people went to jail, CEO, Tyco, and so on, for really small issues, you know, spending money on their shower curtain and stuff. What happened in 2008 was much larger than that, but no one in the American context at the top of the leadership went to prison. And that is a problem. because it sent the wrong signal. And arguably, that's one of the reasons why we have problems with populism and anger against the system right now, because people, the average voter, feels like the bankers got let off and they ended up with the headache and the problems and the negative equity and the sagging wages and so on and so forth. It was a big mistake. We need to learn that mistake going forward, that there needs to be proper enforcement.
And linking back to the question about regulation, one of the things the UK focused on post the financial crisis was better clarifying statutorily the roles of senior managers, including chairs of risk committees and all that sort of kind of stuff, precisely so they could have a more robust enforcement regime after, because the next one, because they figured that they actually hadn't had clear enough requirements in their legislation. And these are not detailed kind of stuff. These are generic kind of requirements for governance and oversight, so that they could actually do a better job enforcing later. And that hasn't happened in a bunch of other jurisdictions. That's effective regulation in my mind.
I would just have 2 points, is that I think culture and conduct are all the more important based, on Elizabeth's comment, because as an institution becomes larger and more difficult and more complex to manage, culture and conduct is even more important, I think, than ever. And on the comment about, whether the bankers went to jail or they didn't go to jail, in the Pecora Commission, they did. And one of the big attacks on the Angelides Commission, which is the one that President Obama put together on the bankers, is that nothing happened. And that's why you have so many politicians comparing the two. But at the end of the day, I think what we're trying to say in all these things is the more complex an institution is and the more difficult it is to manage, the more important culture and conduct is. Because you can't count on the regulators to tell you what to do, because they get around to it too late. And then you have people, in the sense of Congress, the politicians, whether it be here in the United States or Europe or wherever, Canada, wherever, by the time the politicians get to it, it's too late. They're always fighting yesterday's battle, as are the rating agencies, and frankly, in many cases, unfortunately, the regulators and supervisors. So that's why I think it's incumbent on the institution itself to make sure that there is a proper culture and conduct. Each institution is different, and that they embed it, and they monitor it, and they enforce it. Because at the end of the day, what will happen is institutions can disappear. And if you don't have a good culture and conduct and implement it, you'll end up with the institution disappearing in one form or another, merger or whatever it is, or just going out of business. And I mentioned a number of cases where there's serious concerns right now what are going to happen to these institutions. So I think with all the complexity, and we're going to see more of it, particularly in the area of AI and technology, culture and conduct, I think, is even more important than it ever has been in the past.
Bring us home.
Well, I'm not sure this is going to be the overarching question. It's going to wrap this up in a neat bow, but to the point around complexity of these institutions, I sat on the board of a 5-country bank, and my board pack was 1,000 pages in length on a quarterly basis. What were your thoughts with respect to the effectiveness of bank boards in today's age, and whether or not there needs to be an overhaul with respect to the competencies of those boards?
Well, we have I think, an opinion probably of every person on this panel. I think it's very difficult to be a member of a board of a bank today. And I think that when you take on this responsibility, you have to spend a lot of time on it. And I think one of the things we saw coming out of the Great Recession is that in many cases the board didn't know, in some cases they didn't care, or they didn't want to know. And I could cite numerous examples of that. And so I think it starts really at the board level, more so than even the CEO level, because the board has to really set the standard. And so I think the importance and the responsibilities of boards can't be overemphasized. And when you take on a responsibility of a job like this, you really have to understand what you're getting into. And I think that was a real problem with boards prior to the Great Recession. They were all paid well. They were giving nice parties and, all of this type of thing. And they really didn't concentrate on what their role ought to be. And whereas we're recommending that there be a separation, which I think is correct, between the CEO and the chair, in the cases where this is not the case, the lead director has to pick it up. And I think that's another thing where the responsibility has not been properly developed, which is the lead director in any given institution, to set the tone for the rest of the board as well as as a company as a whole. But I think touching on the board is really getting to the heart of all of this, the responsibilities there.
We also see in certain jurisdictions much more focus on that. So in Hong Kong, for instance, they interview board members to see if they're appropriate. That's also the case in the UK now, where you have to be signed off before you can take a board role. And I would emphasize again what Bill said, that the G30 has made it clear that we think the workload is such that you shouldn't be members of multiple boards. That if you've got a significant responsibility, it really almost has to be semi-full-time. And when we hear from our colleagues who are on boards of major GSIFIs in Europe, they're meeting every week. This is not a part-time gig, as Bill said, where you just get to go to a party every 6 months, which is kind of the attitude that was going on in the United States, and that needs to be put an end to. You can't just be a friend of the CEO. You have real responsibility, and the buck stops with you. You need to internalize what it is to run this bank and to understand the culture and to make sure that it's carried out.
So I've been on the board of a Canadian bank for 10 years now, chaired the risk committee for 5. I get the same kind of package you got, but that's only a small part of what I do, right? Because as we said earlier, it's nose in, fingers out, right? Unless you need to have fingers in when you sense what's really good, that something's not going the right way. And that was another problem. There were lots of signals for a number of these boards that they didn't respond to. And it's getting out and about too. It's all kinds of things that you have to be doing as an effective board member. I think what's in the report, which is sort of a glass half full, glass half empty kind of story, generally also applies to the board level. There's been a lot of upgrading of skills across GSIFIs, right? There's been a huge extra focus on people with risk governance experience, risk experience in one form or another, for example. But there's a ways to go. And some of the specific things around structure, like chair CEO, which differs across markets, like actually having a focus in one place on culture and conduct within the board, somewhere. This is a recommendation for a specific committee. So there's a ways to go. So you used the word, does it need to be totally revamped? I'm not so sure it's totally revamped, but yeah, there needs to be further upping of people's games.
And I
it's a
should say
big
that,
challenge.
when you take a look at the United States, Europe, and Canada, there was a big difference. You haven't had all of these problems in Canada because I think that the board responsibilities, and so well, having been on the board and been a regulator, was taken much more seriously than I think the boards of the American banks and the European banks. And Canada's not perfect either,
No.
but I think there is I think a good example of how things can be done better. And so I think there's a lot to learn from where you look at your neighbors, what went right and what went wrong. And I used to always say, when you have a competitor get in trouble, what you shouldn't do is be happy about it. What you should do is find out why that institution got in trouble to make sure you don't do the same, make the same mistakes that they didn't get in trouble. And I think, this is very, very important. I think the Canadian banking system, up to now, and I knock on wood because I don't want to bring you bad luck here, but I think they took things much more serious than we did here, in the United States and Europe.
But then the danger in a market like that is that people get to feel like, well, it was okay, so we actually don't need to keep up while the standard and expectation rises, which is one of the challenges in this sort of kind of area we're talking about. So that's a sort of long answer to your question, but the board stuff really, really matters here a lot to getting this whole thing right.
Well, I'd like to thank you all for coming. I'd like to thank the panel for such a fascinating conversation. 2 things in closing. You should read the report. You can get it off the web, just G30, Culture and Conduct. You can also get it off of our website. And one other thing that we've been hinting at, and I must do a shameless plug here, is if you're really interested in how finance and leadership go together, read Bill's book, Banker for the World. It's well worth it. So with that, thanks a lot for coming. I really enjoyed the conversation. I'll see you the next time the Rhodes convenes.